the Bank of Canada is holding interest rates and the Canadian dollar looks like it's going to collapse. So what is going on here? Let's get right into it. So the Bank of Canada maintains policy rate, continues quantitative tightening. So they're continuing with QT as well. So that's about all we need to read there, because quite frankly, if we read any more there, we will just have brain cells die, because reading through what the Bank of Canada says is just completely pointless right now. So let's see what's going on with the Canadian dollar, which I think is really interesting right now to take a look at. Pretty scary if you're all in Canadian dollars, but if you're not, then you're looking at it and thinking this is actually quite interesting. So this is the Canadian dollar versus the Mexican peso. Today it fell over 1%. That's quite a move. I mean, normally, like before 2020, it would be the other way around. The Mexican peso would be declining against the Canadian dollar. And think about pensioners right now living in Mexico. I mean, they're looking year over year. The peso is down 21%. I mean, the Canadian dollar is down 21%. Over 21%, in fact. So that is not good, because if they're on fixed income, which they will be in Canadian dollars, then they're seeing their income absolutely collapse and crater, as we went through the other day. So it's really just interesting to see this happening, down over 9%, even when you extrapolate it out to 5 years. So it really is quite interesting. The Canadian dollar is really weak right now, and it could only get weaker when you really look at the chart. So I'm going to take you through this right now, what's going on. So this is the Canadian dollar versus the US dollar, and these trend lines, I've had them drawn for ages now. They haven't moved. You can see that the price came up and retested these trend lines. You had a double top, and then it's fell back down and rolled over, and it's now heading down towards this 2022 low. If it breaks that, then it could head towards the 2020 low. And you know, if you want to see this on a simpler chart, I've got one right here to show you. So you can basically see this just looks so weak when you really think about it. I mean, this chart just says it all, what's going on with the Canadian dollar. And obviously rates are at 4.5% in Canada. In the US, they're at 4.75%, and there's an expectation that they're going to 5% at the next meeting. So that's going to put 0.5% distance between the Canadian interest rate and the US interest rate. And really, it should be the opposite way around, because Canada needs to be paying a risk premium, because why on earth is any investor or somebody from the global economy going to park money and invest in a country where household debt is this high and private sector debt is this high, and they know exactly what this means? I mean, a lot of the markets aren't oblivious to the fact of what's going on in Canada. The household debt, the private debt is a recipe for disaster. You know, we just had the GDP numbers come out, and GDP was flat. GDP was flat for the quarter Q4 last year. So that's really interesting. Could we get a negative quarter next time? It's very likely. We could already be in a recession, in fact, right now. And you have to remember that GDP is not a good way of measuring the economy, but it's one of the only ways we have. It includes government spending, it includes debt creation, and in the long term, those things aren't good for the economy, and those things are inflationary to the economy as well. And now I want to take you through this, because I think this is just, this just kind of shows it all, basically. So this is about imports in January. So I'm just going to read through this, and I'm sure you'll find this incredibly insightful. Imports to Canada increased 3.1% to 65.1 billion in January after 2 consecutively monthly declines. Imports rose for motor vehicles and parts 11.1% to reach a record of 11 billion. In particular, engine and parts 13.1%, and passenger cars and light trucks 8.4%, industrial machinery, equipment and parts 10%, electronic and electrical equipment and parts 5.1%, namely communication and audio and video equipment up 11.7%, and computer peripherals up 9.7%, and consumer goods 3.8%. Imports from the United States rose 2.3%, and from countries other than the United States rose 4.6% in January. Imports from Mexico, trucks, and Switzerland, pharmaceutical products, led to an increase. So lots of increases there, most of them near or around 10%. So that goes to show that the import costs are rising. And really, this is just going to continue when you really think about it, because if you pull this out to a month, the Canadian dollar is down 2.58% against the US dollar in a month. So think about that. Even if oil prices, if energy prices were flat, you are seeing a rise of at least 2.5% just due to the weakening currency. And this is where the Bank of Canada, as dumb as they are, don't understand what they're doing, because essentially they could be playing in a game that they don't even know what the outcome is going to be, and they don't know what the outcome is going to be. I mean, do they know that the economy is likely going to head into a recession? Yes, but what is going on right now is just looking really, really bad from the standpoint that if the Canadian dollar continues to weaken, they'll be forced to increase interest rates. And if it continues to weaken, that means it's more bullish for inflation. You're more likely to see more inflation. And that means that we're more likely to see higher rates. The bond market sell off, even though the bond market was up today. So really, really interesting when you think about it. And another thing that I wanted to show you real quick was what went on with the Canadian dollar and gold. Canadian dollar and gold, it actually rose today. So, that just goes to show gold is doing its job in just essentially being a store of value with what's going on and just being insurance on these fiat currencies with everything that's happening with the Canadian dollar. But I think it's just really, really interesting that you've got declines of over 21% against certain currencies like the Mexican peso. And you have to think, well, why is that? And we discussed this. It's because the interest rates in Mexico, they're paying a lot more. There's a lot more onshoring. So that means that there's a lot of manufacturing and investments coming from China and the United States into Mexico. And a lot of countries are just looking at Canada and they're passing it by. It's not a good sign. And we're seeing unemployment rise in provinces like Alberta, Manitoba. So it really doesn't look good from that standpoint. And, the household debt, the private debt, it kind of paints the picture of the situation that investors are looking at in Canada. They're thinking, well, it looks very risky to park my money in Canada. And the Bank of Canada isn't paying for that. They're not paying for that risk, that extra risk. And that, I believe, is why we're going to see the Canadian dollar fall over the long-term picture. We're likely going to see some pullbacks in the near term because of what's happened. It's sold off and it's getting to a point where it's nearly oversold. And plus, we actually broke that low, which I'll just show you there. So we actually passed, I forget the chart, we had a low, but yeah, I forget which chart I was looking at now. But yeah, we did hit, it was the 6-month low. We passed this low yesterday and today, so we're likely going to see some pullback. We hit a new low here today. You can't really see it on this chart. But yeah, it's been over 6 months now since we've seen the Canadian dollar versus the US dollar that low. So it's kind of insane where we're at right now, but I think it's to be expected, and we'll have to see what unfolds with the Canadian dollar. But is it going to be the same as the British pound? Are we going to see bond yields start to ratchet up? as more people start to realize, oh crap, I don't want to be in Canadian dollars anymore, they start to sell their bonds and move the money out, which means that you just get into this doom loop that happened in the UK, and we covered on this channel, and led to the pound crashing over 5 or 6% in one day. It was just absolutely insane. And then the Bank of England had to come in with a rescue package. But in the end, what we're seeing is that flip over right now. So it's very, very interesting, and maybe we'll get into that in another episode. So if you've enjoyed this video, you might like this video here. You might also like that video there. Thank you so much for watching, and I will see you in the next one, guys. Take care.